I'm Adam Myers and I lead the distribution team at Pengana. Thank you for joining us for this webinar update with John Moog, the portfolio manager of the Pengana Small Companies Fund. From a format perspective, John will keep his prepared section reasonably short, so we'll have plenty of time for Q&A at the end. So any questions that you have about the fund or the economic environment or specific exposures, please enter them into the Q&A box, which can be accessed from the icon on your screen. And hopefully within the constraints of a Zoom webinar, we can have a really interesting conversation at the end. John, over to you.
And for those of you who don't know me, my name is John Moog. I'm the portfolio manager here at the Pengana Global Small Companies Fund. Thank you very much for your time this morning. I'm over here in Chicago in the US, and it's afternoon here. So thanks everyone for getting up early and listening. Today, before we get into the deck, I just wanted to kind of outline what we'll be covering today. But again, as Adam mentioned, we're going to be keeping the prepared comments fairly short. We're going to talk a little bit about who we are and then get into the environment and the portfolio a bit and some recent investments we've made, but really looking forward to getting into the Q&A portion where I can answer some questions about what we're seeing, given it's such a dynamic environment right now, and I think we're all living through a period where it's pretty challenging. So I think I'm looking forward to the conversation and at least sharing with what we're seeing and looking forward to hearing what you guys are thinking about and what you're seeing. So Lizard Investors has been around since 2008. We formed a partnership with Pengana that began in 2015 when we launched the Global Small Companies Fund. Our focus is really primarily on the small companies, so small caps around the world. And we think we have a fairly unique process for finding these businesses, researching these businesses, and investing in these businesses. And I think it creates a concentrated group of high quality businesses that will generate returns and cash flow over a long period of time. And I think that's something we're proud of. And I think we've proved over a long period of time it works quite well. We're focused, again, in terms of what you get in the fund and what it is we do. We're very much focused on high quality businesses that will protect on the downside through really good balance sheets and being around and being able to grow and prosper in tough times as well as good times. And we also think these high quality businesses are the best vehicles to compound growth in the small cap space. We're cash flow based investors. We invest with a 3 to 5 year horizon, and again, a high conviction portfolio. So top 10 investments for us typically make up between 30 and 40% of the portfolio. What we look for in any investment we make are really 5 compelling features of a company. And we're bottoms up investors. Obviously, we have to spend quite a bit of time thinking about the macro environment. We invest in a lot of different countries around the world. And so we spend time on the macro, but what we really are seeking are some critical criteria that we think mean that a company can really succeed through really in any region in the world, in any really economic scenario. And these are the companies that we think can year in and year out create value for investors. So what we look for really are 4 qualitative credit features. The first is what we call it a sustainable business model. What this really means is we want businesses that can earn high returns on capital over a long period of time. And we're very focused on finding businesses that where we understand what the quote unquote engine that drives the business is, what's really the competitive advantage that will allow this business to create value with high returns over a long period of time. And that's the kind of the North Star of what we do. The second thing we look for is a balance sheet that is supportive of the business. So we're not completely debt averse, but we want a business that's able to fund itself through really any market environment and won't require equity investors to dilute themselves when there are downturns. The third thing we look for is an aligned management team. So we want a management team that has skin in the game, much like we do, who lose money when our investors lose money and make money when our investors make money. And this is something we think is really important, especially once you get into the small cap space. Sort of side by side with it, we spend a lot of time thinking about corporate governance. We want management teams, we want company structures that protect minority shareholders and also really take into account all key constituents. And we really think that's important in terms of driving long-term value of the business and really protecting that long-term value of the business. So again, we want businesses that treat us like minority partners and put governance at the forefront. And the fifth thing we look for in any investment we make, and this is kind of the first four are what make a quality business in our view, and the fifth piece is compelling valuation. And we think about valuation really from a standpoint of cash flow-based investors. We think about free cash flow yield, EBITDA, other indicators of cash flow, and typically we want to be paying about half of what we think a business is worth on a 5-year horizon. And so generally we want to be putting capital to work when we think we can make high teens returns a year over a long period of time. So again, to get capital into a name, to invest into a stock, a company must meet all 5 of these criteria when we make an investment. And ideally what we build is a portfolio of reasonably idiosyncratic businesses that meet all these criteria into a reasonably concentrated portfolio that we think can compound value over a long period of time. Now I'm going to move into a little bit about what's going on in the world. Obviously, that's a focus for a lot of the financial industry right now. It's really been a unique year and a half that we've been living through, really since the beginning of COVID. And so I want to just spend a few minutes talking about some of the things and forces we think are impacting the markets. Obviously, it's been a very challenging market this year, especially for global small caps. And so I just want to spend a little bit of time with some of the things that we're thinking about and looking at before I get into some individual equities. The first thing, I think we are all aware of is there's certain economic headwinds that are out there right now. Obviously, growth is slowing in a lot of places in the world right now. We've got a lot of inflationary pressure out there in the world, and what does all that mean? And I think one of the things that we're starting to see, obviously, if you kind of rewind the clock 6 months ago, investors were rightly very concerned about inflation, rising rates at central banks all over the world. And what it has led to is, unfortunately, some of the economic headwinds are really starting to pinch, we think, economies around the world. And I think one of the things that we're seeing in regards to that is earnings is a proxy for overall economic activity are starting to come down. So we're starting to see earnings downgrades, which are an indicator that we are starting to see economic growth slow down all over the world. We think it's very likely that we'll be in a global recession or something that looks like a global recession for the next couple of quarters. But on the flip side of that is the positive impact is that we are starting to see some of the inflationary pressure abate. We're starting to see, and here we have US CPI and US CPI expectations on the right chart here. And what's interesting is it is starting to roll over. We see this, and this is a good barometer for really what we see around the world in terms of inflationary pressures. They are starting to subside. Even some of the European energy issues are starting to subside a bit. And so from our perspective, while the earnings downgrades and the economic pain will be real, we also think the longer term problem of inflation is starting to come under control, which I think is quite a positive in the grand scheme of things. So where are we, and what are the things that I think really will matter over the next 3 to 5 years for our asset class, and how do we think about those things? The first thing I just touch on is it doesn't seem like there is an imminent catalyst to drive significant revaluation in shares. And what I mean by that is we know there are going to be more earnings downgrades coming. We think that'll last a few quarters. It's tough to look out and say in 6 months, stocks are going to be, valuations are going to be up and stocks are going to be ripping back. That is usually the way it feels in most bear markets and towards the bottom of most bear markets. But given that, we think the table is really being set, so to speak, for a really positive longer term outcome for returns in the global small cap space. And let me walk you through why I think that's the case. The first thing I would say is that we are near a multi-decade, 30 to 40 year high in the US dollar. I think that is really meaningful when you think about what some of the implications of that are. The first thing we think is that non-US stocks are really starting to be poised for a long run of outperformance after what's been a really long run of underperformance. And let me walk you through some of the moving parts of that. The first is some of the earnings tailwinds that have really benefited the US over the last decade will now start to benefit non-US stocks. And what I mean by that are, with a very expensive US dollar, many of the costs in non-US companies will be at a comparative advantage relative to U.S. companies. So my labor costs, my cost of goods sold, a lot of other pieces will start to be very cheap relative to the U.S. dollar. And so manufacturing cost advantages in non-U.S. companies will start to shine through. The caveat to that is we really need energy prices in Europe to recede. Once that happens, we think that Europe will have a fairly sustained cost advantage over the U.S. And we think that will lead to faster economic growth in many regions in the world, and also be a driver of share prices. The second thing that really is very simple and is kind of the anecdote of what's happened over the last 20 years in periods of outperformance and underperformance and why that's the case. And it's some empirical evidence, I think, supporting what I'm saying, which is I think if you look at the period from, let's say, 2001 to 2008, that was the last period where non-US stocks outperformed US stocks. And these typically are, decade type periods of outperformance and underperformance is what we see historically. And so what you had leading into 2001 was an expensive US dollar. Here you can see the peak on the chart, not as expensive as it is today, but certainly quite expensive. And you had a scenario where you had quite expensive US stocks relative to stocks outside of the US. And so starting in 2001, you saw non-US outperformed as the dollar weakened, and as you saw multiples mean revert to more normal levels between economies. And so you saw a long period of outperformance for non-US. And then with the dollar bottoming in 2008 and 2010, you saw that switch. And so at that point, US was at parity with non-US stocks in terms of valuation, and the dollar was quite cheap. We've now been through let's say a 14-year bull market in the dollar and a 14-year bull market in US stocks. We don't think that's an accident. And obviously the economic growth in the US combined with the strong currency has driven quite a bit of equity appreciation. And so where do we sit today, right? We sit now at a 30 to 40-year high in the US dollar. And here on the chart on the right, we've got valuations between different geographies. And here you can see the US is trading at a 16.7 times earnings multiple. And non-US developed is trading at 11.5 times, and emerging markets are trading at 10.5 times earnings. So from a valuation standpoint, those are really significant differences. You can see those were quite compressed in 2008. And we're starting with a very strong US dollar. And so as that reverses, not only going to get the currency kicker, but you'll likely get significant value as valuations kind of revert to the mean, if you will. So again, we think these are long-term trends. We don't see a catalyst for this necessarily reversing the next month or 2 months, but we think on a 2 to 3 year basis, or even a decade basis, we think non-US is really well situated to outperform. And one of the reasons we're quite bullish on non-US stocks, given where multiples are today, where the dollar is today, and despite some of the more challenging economic headwinds I think the world's facing. And so what does our portfolio look like today? What are some of the attributes of the portfolio and how attractively is it priced? Here we have our portfolio with some metrics compared to the index itself. I think one of the things that stand out for me, the first thing is just from we use price to earnings as kind of the simplest valuation tool to compare indices. One of the things that's really interesting, our portfolio is at a little over 13 times earnings for 2022. Index is at 14.5. Those are, I think, on an absolute basis, quite compelling multiples. But I think what's more important is that everything has sold off in the small cap space. So in the large cap space so far in 2022, you've seen kind of a dispersion in returns between certain large caps. And you've seen stocks outperform pretty dramatically, and then those stocks with poor fundamentals underperform. In the small cap space, there's been much less dispersion in returns, and that isn't a good thing, unfortunately. Really, all small cap stocks have been hit pretty hard this year. Obviously, there are going to be some exceptions, but by and large, the dispersion in the small cap space has been much smaller. So you've had small cap sell off indiscriminately. And I think what shows up in our portfolio is showing up as really the big opportunity out there in the market right now is that, we view our portfolio as quite high quality. And I think the evidence for that is a return on equity of 30%, a net debt to EBITDA of 1.1 times versus the index at 2.8 times, and frankly, faster earnings growth over time. And to us, that indicates that those are higher quality companies. And still in this period, you're able to acquire those companies at a multiple similar to the index. And for us, that means this is a very good market for those people out there who can go hunt for great companies at bargain prices. And we think it's the first time in quite a while, given the lack of discrimination in the market, that you can go out and buy these companies at these types of prices, because just no one really is out there paying attention and everyone's so focused on the macro. So for us, it's actually quite a good market to sow the seeds for success over the next 3 to 5 years. And so again, in terms of our core positions and the attributes they have, again, low teens cash earnings multiples. That means you're earning high single-digit yields on cash. Fundamentals, generally speaking, across the portfolio are holding up well. We would expect some deterioration in earnings cyclically over the next 6 months, but by and large, fundamentals are holding up quite well across the portfolio. And what the other piece that we really like here is that these are names that we've known for a long period of time. We know these names really well. And they're trading at multiples that are, we haven't seen in a decade. And so I think all of those things, despite some of the near-term headwinds, make us quite optimistic. And I think where the areas we're really focused on avoiding in the portfolio are areas where we think their economic pain is going to be quite acute, because we do think there are areas in the world, in sectors and geographically, where there will be pretty serious economic issues. Where the macro will overwhelm the micro, so to speak. And those are issues, those are places we want to avoid, both from a sector and a geographic perspective. And so those are things that we've trimmed out of the portfolio. But overall, again, I think what I would say is the opportunity set today seems quite good on a long-term basis. There are near-term headwinds. And I think those are things that concern us, but ultimately, we think it's a great time to be putting together a portfolio that will perform well over a 3 to 5 year basis. We're putting capital to work pretty selectively right now. So we have a list of companies we'd like to buy, where we are buying some based on current opportunities presented, but we have a much longer list of companies we'd like to buy as we kind of work our way through this crisis, so to speak. Now I want to just give you a few examples of the types of businesses we're investing in. And how the opportunities have presented themselves, because I think it's helpful to kind of understand how significant some of the sell-offs have been in the small cap space and the opportunities that are out there. The first name I wanted to touch on is INTEGRAFIN. INTEGRAFIN is a B2B supplier of tech and customer relationship management software for independent UK financial advisors. So they would operate in the financial advisory space, similar to how Australia or the US might work. The UK has shifted from a defined benefit model for retirement to a defined contribution. The advisor networks in the UK as they've developed are the large wirehouse advisories. Those are, then they have kind of the vertical operators, and then you have the independent financial advisors. INTEGRAFIN is the largest provider of technology and platform in the UK for the independent financial advisors. I'd imagine many of you are familiar with kind of conceptually what I'm talking about. What we love about this business is the AUM is very sticky. Advisors do not switch very often, and INTEGRAFIN is the leader in the marketplace. Very high returns on capital, very high operating margins in this business, no debt, and really kind of the best in class in this space. This stock used to trade, and given sort of the shift to defined contribution, this stock has grown, the revenue of this business has grown 10 to 15% a year and will continue to grow 10 to 15% a year, despite any fluctuations, with fluctuations in AUM. And so AUM drives the revenue line. We've seen AUM down a little bit this year, just given what's happened to asset prices, but there's been no change in terms of, in fact, they've gained market share, and there's no change to the structural growth in the business. And what's been interesting here is that this company's derated from over 40 times earnings to just 15 times earnings. And this is for a business that again, grows 10 to 15% a year, has returns on capital in excess of 40%, has a net cash balance sheet, meaning they have absolutely no debt and quite a bit of cash on the balance sheet, generates a ton of cash, and has a very sticky customer base. And so from our perspective, and you also have quite a bit of insider alignment with insiders and employees owning just under 20% of the business. And so from our perspective, we have not seen a scenario where you can buy this type of quality business with structural growth a leading market position for 15 times earnings, and frankly, probably since 2008. And so from our perspective, and here you can see how much the shares have derated, right? If you go back to 2018, the shares moved up quite a bit and have just really come down 60%, not really because of anything fundamentally wrong with the business, but just because it is a small cap stock in a market that's absolutely shredded small cap growth stocks. And so for us, these are the types of opportunities we're starting to see and starting to invest in, because we think on a 3 to 5 year basis, it's really going to be challenging to lose money, and the opportunity to make a lot of money here is quite good. Similarly, another name I wanted to touch on is Melrose in the UK, also in the UK. And again, I think I just wanted to touch on this one because I think what you're seeing is some fairly irrational moves in stock prices given the environment. And so Melrose is a holding company, technically a holding company, but an investment company. And effectively what they do is they buy an industrial company that has a market leading position in terms of the product and has a large recurring revenue base. And then they will find a business with those attributes that is not optimizing its margins, and they will go in and optimize margins, improve operations. And they've done this 3 or 4 times and created about a 20% return a year for shareholders over the 20-year existence. So Melrose recently announced that they were going to spin off the auto division of their industrial business they own, which is called GKN. And the market absolutely had a fit. Here you can see the stocks sold off almost 60% post June 2022 when they made this announcement. From our perspective, this is absolutely a rational economic move. I think the market was a bit disappointed they weren't selling the business. Again, the business is in auto right now, where you have significant supply chain issues and would be a terrible time to sell the business. We also think the spinoff creates an opportunity for them to use the auto business to acquire other auto businesses at quite cheap prices right now. And so for us, it was a very economically rational business. But what was really interesting is after these shares sold off, the implied value of the business was 4 times EBITDA for the auto business and 8.5 times for the aerospace business. GKN is a very high quality aerospace and auto business. I would say typically these multiples would look more like 8 times for the auto business and probably 12 to 15 times at the low end for the aerospace business. And so again, we think this is an industry leading business that has been sold off by shareholders for what we think are more emotional reasons given the current environment, but an opportunity to own an absolutely fantastic business at what we think is under half of the intrinsic value of the business, with a management team that's proven they can generate 20% a year for shareholders over 20 years. And so, this is a bit of a different example, but I think from our perspective, some of the inefficiency that's out there in the market right now and how we're trying to position ourselves to take advantage of it, because we think these opportunities, these sell-offs and these bear markets are really painful, but these are really the opportunities to go out and find these unique, interesting businesses at really discounted multiples. And that's really where we're spending our time and what we're excited about right now. And that's at a high level what I wanted to cover in the prepared remarks today. Now we'll move into Q&A with Adam, and hopefully we'll have a very interesting discussion with you guys, given given some of the macroeconomic issues and some of the company specific issues we're dealing with. I think there's a lot to talk about. So thank you for listening to my prepared comments, and let's move into the Q&A, please.
Thank you very much, John. The questions really do provide us with great insight into the key concerns of our investors, and questions about inflation and interest rates, both expectations and effects, have certainly been the most asked questions throughout the series, and this webinar is no different. So kicking off with the first question: if inflation is starting to moderate, do you think interest rates are fully reflected in current share prices?
So I think that's an interesting question. It's one we've thought about. And I think what I would say is, in general, that's probably correct. The only 2 things I would comment on is, and I think what I mean by that is I think we've seen multiples contract to a point that makes sense for where interest rates are. But I think the second point I would make is that I think we are at the beginning of an earnings downgrade cycle. And I think, as I said, there's been a very significant lack of disparity among how stocks have reacted. And so I think in some cases, I'd say in the market in general, that's probably accurate. But as I look at kind of specific companies and where you might have earnings misses, so to speak, but also where you might have opportunities to buy really good businesses at cheap prices, I think the disparity there is quite high. So I'd say in the market in general, I think that's probably accurate. But I think on a micro level, when you start looking at companies, I think there's going to be quite a bit of differentiation in returns over the next couple of years as interest rates moderate.
That makes sense. You spoke about the strength of the US dollar providing tailwinds for non-US manufacturing particularly. You guys obviously are overweight to the European and non-US segment of the market. Will you reduce that overweight when the dollar starts to correct?
Mm-hmm. Yeah, and I think, I want to be a little careful. I certainly spoke about non-US manufacturing, but again, manufacturing tends to be an important driver. Manufacturing and services tend to be a very important driver for overall economic activity, right? And so as those things start growing faster in other geographies, you'll see the overall geography start to grow faster, right? Because it feeds into the consumer and a lot of other things. And so, I'm just not saying that it's going to be non-US manufacturing that will do well, but I think, a lot of the ancillary things that benefit when an economy starts growing will do quite well as well. In terms of, where we're going to have our positioning and what we're going to do with our positioning, what I would say is, I would certainly expect as the dollar weakens, if and when the dollar weakens, well, when the dollar weakens, I don't think it's an if, but when the dollar does weaken eventually, we would expect there to be more opportunities presented to us in the US space. We are a bottoms-up investment firm. We don't really allocate based on geographies in that way. But what I would say is we would certainly expect that US opportunities start presenting themselves more frequently in that context. And so, I would expect our weighting to change over time. I don't think it will be sudden. And I think these are fairly long-tailed trends we're talking about. But I do expect over time, as the dollar starts to mean revert, our weighting in Europe will come down and our weighting in the US will go up.
Great. We've received a few questions about your European exposure, so I'm going to try and consolidate them to give you an opportunity to speak about Europe more generally. Inflation, the slowness of structural reform, the looming energy crisis, particularly as we are coming into the northern winter. Is there any concern that you may be overexposed to this region?
I think a couple of points to make there, which I think are important. The first is, related to some of the places where we think the issues may be more acute, Germany, manufacturing base in Germany, those are issues we're actively trying to avoid in the portfolio. So, I don't want to broad base paint Europe as one geography. To some extent, we look at it that way, but at the same time, we think there's going to be meaningful opportunities for differentiation across the continent, and the other thing I would say, and in that regard, we're just seeking to avoid some places that we think is going to be pretty brutal. The other thing I would say that I think is probably more important is that the market is very good at discounting these things historically, right? And we've already seen, I'll go back, if I'm just going to flip back to this slide and this chart on the right here. We've already seen multiples move pretty dramatically away from each other, right? And so you've seen the US relative to continental Europe and emerging markets, you've seen that multiple differentiation already really blow out, right? And so that spread to me already indicates most investors would have this as their consensus view. And so from that perspective, when I look at kind of absolute and relative valuations, and how bad things could get in Europe, we think a lot of that's been discounted, and there's just a significant opportunity to find these high quality companies that I talked about, given how much capital is left Europe and how few people are actually looking for these types of companies in Europe. And in 6 months or 12 months, when people start looking at Europe again, we think capital will start coming in back in quickly, but I think you already have wanted to be positioned to take advantage of that. So, these things are frustrating in Europe. The other point I would make is that, I think one thing about the European culture and at least American, is that when you hear about a problem in America, it's really a problem. When you hear about a problem in Europe, there's some pessimism already baked in, and so it may not end up being quite as bad as you fear. And on the energy front, the one thing I would say is that, Germany has actually at this point, while I wish there was a better long-term solution in place, has already secured a very meaningful percentage of their energy needs for the winter. And so that being said, the odds of them going through a situation where there's no energy in parts of Europe for the winter is very minuscule. They have significant energy reserves. They have an ability to get through the winter. It may not be pleasant given where the prices are, but I think there's a lot of that is already understood. And then we start looking into next year and hopefully an opportunity for continental Europe really to start addressing their energy needs in a more productive way in a more productive long-term way.
Okay, great. Thank you. Next question. You don't seem to invest in the sectors that have performed best this year, mainly energy. Why not?
So, yeah, that's a great question. And I had this question a lot when energy was performing poorly, and I obviously have it a lot when energy is performing well. For us, again, back to the core criteria we invest in, we look for businesses, again, that first point I made is we look for businesses that can earn high returns on capital over long periods of time. And energy is a industry, and this is, not every company, but by and large, you see very significant fluctuations in return on capital based on what the underlying commodity price is. And you also see over a long period of time, fairly low returns on capital. And so from our perspective, it just doesn't really meet the type of businesses we want to invest in over a 3 to 5 year basis. Again, there are exceptions in the energy industry, and we've looked at businesses and invested in a few energy businesses over time. That being said, I think by and large, in terms of why we don't invest in energy is outside of the market cycle related to commodity prices. We don't think by and large it's a great place to find businesses that will be able to compound value over a long period of time.
Okay, but how much does that cost from a performance perspective? You may not know that offhand, but can you?
Yeah. Based on some of the recent attribution data we've been looking at, it's cost us about 1.5% this year on a relative basis.
On a relative basis, and your US dollar.
The other. If you look at the big areas from an allocation standpoint, again, we're bottoms-up investors, but if you look at the big areas of dispersion relative to the benchmark this year, the first is energy's at about 1.5%. The bigger one for us has been the underweight the US dollar. Given that we're underweight US and overweight other parts of the world, we're sort of naturally short the US dollar, if you will, relative to the index, and that's cost us about just over 5.5% in relative performance this year. While that's been painful, I think from my perspective, if you look at the 15-year history of the firm, the currency and energy, this has been the most extreme impact that it's had in any year since we started in 2009. But that being said, if you look at it over time, these issues tend to be a wash if you look at a longer term time horizon in terms of performance on the fund. And I think I'd be much more concerned about the performance of the fund if it were our actual equity investing, our stock picking that was the problem. But if it's really kind of allocation to those sectors that we think over time if we continue to buy high quality businesses at attractive prices, we think a lot of this kind of is noise, and we think the fund will be able to outperform based on kind of the quality of business we're investing in and the valuation we're investing in them at.
Completely agree, but we as investors tend to be a little short-term in nature, and a 7% headwind over this year has probably been quite significant.
Very frustrating for us as well, so we understand.
We have got a few company-specific questions that have come in. One is, do you still hold Serco, and are you concerned about a slowdown in UK public spending?
We still own Serco. It's probably down as a percentage of the portfolio, so it's still on the edge of being a top 10 name. it was a top 5 name probably earlier this year. After the stock has run up a bit, it's probably down to kind of, around 10th largest name in the portfolio. In terms of the concern level in UK spending, a couple things while we have mild concern about the overall level of spending in the UK, I think there are a couple things here that make us less concerned related specifically to Serco. The first is that if you look at the UK over the last 5 years, a lot of the government contractors and government businesses have been driven almost to the brink of bankruptcy. Serco had a really rough run about 5 years ago. Stock was down really significantly, and they were probably the best performer in the UK. You had a couple of businesses go out of business, and it was really aggressive tone from the UK government. And it's really kind of came back to bite the UK in the nose, so to speak. And so on one hand, we could see some reduction in spending, but on the other hand, we don't think they can afford to really alienate their supply base, given kind of what's happened over the last 5 years. The second thing I would say here is that Serco has a reasonably large non-UK business. So over 50% of the revenue actually is not from the UK. About 60% of their non-UK revenue is in the US. So you have a significant translation benefit. And what I mean by that is revenue is going to grow automatically just from translation back to pounds from US dollars. And secondly, I think the other place that Serco has some businesses in the defense business in Europe and the UK. And given the environment in the Ukraine, we don't think it's probably realistic that you're going to see European governments cut spending on defense. In terms of really making sure that they have defense capabilities over the coming decade, given what we're living through in the Ukraine right now. So I think all of those reasons make us pretty optimistic that Serco will be fine. Given the multiples is trading at, it's probably trading at 12 times earnings right now. We would view sort of a flat top line as really a worst case scenario. And so if you have flat revenue and flat profits at 12 times earnings, I think you're still pretty well protected on the downside. And again, we think that's probably a worst case scenario for the fundamentals of the business.
Can you briefly just describe Serco's business? They're not making guns or weapons. Just very briefly, from an ESG perspective, can you just comment on that business?
Yeah. So most of a large majority of what Serco does are traditional government services. So this would be, it's called MRO, but maintenance and repair of government buildings. Anything from kind of cleaning services to just managing facilities. These are fairly mundane, service-oriented types of businesses that have long-term contracts, good cash flows. They also, for example, in Australia, they manage the visa program in Australia. So it's traditional government services. The U.S. piece is actually the largest defense business in the portfolio. And these would be related more to research and research-related activities. So it's more personnel, and it's not manufacturing of weapons or anything along those lines. In fact, at one point, I want to say it's a decade ago, they had a nuclear business, not related to nuclear weapons, but related to nuclear subs and how they ran. But that business was divested, I want to say it was around a decade ago. So anything really from an ESG perspective that would be controversial is no longer part of the portfolio.
Great, thank you. Are you concerned about the change in government in Brazil? You have some significant holdings there?
So one of our largest positions is Açaí in Brazil, which is a food retailer. They are a discount food retailer, and what I mean by discount food retailer is they are kind of a large hypermarket, big box discount retailer, and would sell food typically at a 20-30% discount to what you would be able to purchase food at in a local grocery store. Why I think that's important is related to an election and really any change in government, especially in emerging markets. There are industries I think you want to participate in, or there are industries where you don't need to be worried, and there are industries where you need to be worried. If you are the low-cost provider of food, really in any geography, I think the risk of any government change is pretty minimal. So from our perspective, low-cost food works really with any government, especially when you're looking at emerging markets. We've seen this in various holdings over the years, but I think given what Acai does, and given it's really our only holding in Brazil right now, we're pretty comfortable with that. I think that the other reason, I think in Brazil in general, I wouldn't be overly concerned. I mean, I think it's something to pay attention to, but is that the election was quite a bit closer than I think people would have expected 6 months ago. And so I think Lula, who's back in office, his mandate to really go out and make significant changes that would be destructive for equities is pretty limited given how close the election was.
Great, thank you. I think I have now asked all the questions, or at least a variation of some of them, but I think we've got to the key topics. If you feel that your question hasn't been answered, please get in touch with us and we'll obviously respond to that. Our next webinar in the series is next Tuesday, the 15th. It's at 9 o'clock in the morning with James McDonald, who is the portfolio manager of our high conviction equities fund. James has a particular focus on emerging drugs and emerging technologies in the medical space. So his webinars are always fascinating. I urge you to register for this on our website, pengana.com. If you have any other questions, please get in touch directly. We'd love to hear from you. Thanks again and enjoy your day.